Now, at a recent event here, Steve Leisman has all the details. What can you tell us, Steve?
Not just any voting member, Dominic. It's Phil Jefferson, who is the new vice chair of the Federal Reserve Board of Governors. He says financial conditions have tightened further. He says real long-term yields have risen significantly. And he will take financial market developments like these into account, along with the incoming economic data, when he figures out what policy is. The upward movement in yields, he says, could reflect the view the economy is stronger, but that also reflect changing attitudes towards risk and towards the uncertainty that's out there. So he's not really telling you exactly how he would fall with these higher yields. He says the Fed is in a position to proceed carefully, and the Fed also is in a, quote, sensitive period of risk management, which means they're watching this stuff very closely. Too soon to say, he says, we've tightened enough, particularly tentative, he says, to upside risk to inflation and the possibility that inflation expectations become unanchored. Not saying that's going to happen, just say he's watching it. More broadly or specifically on inflation, he says, while recent inflation data has been encouraging, it remains too high. He does see a path to lower inflation without a big increase in the unemployment rate. He sees inflation moderating further as a result of the labor market coming into better balance. Core non-housing services, he says, have yet to show a significant slowdown. That's that area that Fed Chair Jay Powell is watching very closely. So far, he says the economy has been resilient. And then he goes on to talk about downside economic risk, which includes slowdowns in foreign economic growth. He singles out China and Europe as two areas he's watching very closely. He expects further gradual easing in the labor market conditions, despite, he says, that very high job number we got last Friday. He's aware, though, of more corporate refinancing that could create further tightening in policy. Maybe not quite as outright dovish as Lori Logan was, but remember, Lori Logan, the Dallas Fed president, early this morning, gave us two sides, Dom. She gave us the side about, hey, higher yields may mean the Fed doesn't have to tighten further, but it could also mean a longer neutral rate, a higher neutral rate.
Steve, speaking of the Fed, the odds of a rate hike at the final two Fed meetings of the year have fallen rather notably over the course of the last few days here, especially in light of what's happening with geopolitical tensions in the Middle East. Can you take us through that dynamic right now, the odds and probabilities of what the Fed may or may not do at November to the balance of the year?
All that is 100% accurate, Dom. I think we went into this day here, or let's say we left Friday after that strong jobs report with about a 30% probability of a rate hike in November. That has halved today, down to 14%. And then let's say we're up near 45, 46% for December. We're now, I'll do the math for you, call it 27, 28%. So just a 1 in 3 chance. And let me just double check here no, it did not push ahead to next year at all. And then when I look further down the road, you know, they're starting to maybe bake in, Dominic, a cut in May. And let me just explain the context here. Where the market prices in the first cut has moved from May to June. On hawkish days, it's July. The mid-range is June. Today, call it a dovish day because of the factors you put out. Both the Fed speak about the idea of yields being higher and the geopolitical situation, the awful Hamas terrorist attack in Israel. That moves some of the thinking, not quite odds-on bet, but an even bet that first rate cut happens in May, Dom.